I'm going to keep this brief. I'll try to restrict this to about 20 minutes. This is the third part extension to the lecture from chapter 4 in our book. Remember, I had to talk some about topical events, and I promised that I wanted to say more about the 2000 market collapse, the so-called .com crash that I have in recent years, because I think it's important that students your age know more about what happened in those years, because I think it very possibly will be repeated in your lifetime, and maybe if you know something about the old story, you'll see the new story before it happens. Now, in the last lecture in class, I showed you this slide about momentum markets, and I want to start with this. Momentum markets theoretically aren't supposed to happen, but they do happen, and they happen when markets just run and run upward mostly with some volatility for a long period of time. And they can approach prices that by any reasonable standard are too high, and at some point they collapse. And that is how the 2000 crash actually began. The lead up to the 2000 crash was a momentum market where the stock market just absolutely accelerated. As I reminded you here in this slide, it was probably because the market had been undervalued consistently in the inflation years. There was a catch-up period after the 1980s when prices rose just to get up to where they should be, given the price-to-earnings ratios of the time. Then, of course, the new World Wide Web and assorted companies came online and provided a little excitement. And once that happened, then the runaway market was a certainty, I suppose. And as you can see in this bottom graph, the NASDAQ composite, which was more tech-heavy than the Dow or the S&P 500 at the time, rapidly accelerated and then rapidly collapsed. Now, here's some of the characteristics of the .com sell-off. It's called the .com sell-off because so many of the companies had been created to provide markets to, or the promise of providing markets to the World Wide Web. They were in the markets, the stock market in particular was in a spec frenzy because of the promise of the internet, or then they called it the World Wide Web, and all things World Wide Web, including companies that launched that promised to deliver this resource or that with spectacular growth. In the first quarter of the year 2000, the NASDAQ had its final spectacular surge of growth, growing, remember, about 25%. I didn't take advantage of that. I could see this problem coming, but I sold all of my stocks in late 1998 and was down to basically no equities 18 months or so before this actually happened. So I didn't benefit from the 1999 rise either, and certainly not the first 3 months of 2000. So don't get the impression that I'm telling you that I sold at the peak, because I didn't. The sell-off begins with a warning from an obscure company at the time called MicroStrategies. That seemed to be, as they say, the straw that broke the camel's back. As I said in class, the market had been somewhat volatile despite its upward move through the first month of 2000 and the final months of 1999. But the one thing that seemed to, whatever market, send the market reeling, where all of a sudden there was a sort of razor's edge phenomenon, where all of a sudden everybody thought stocks were overvalued, was this single incident, a strong warning from one of the darlings, MicroStrategies. The NASDAQ fell 39% for the year 2000, and as you know, we haven't seen anything like that in recent years, and it fell 50% from the peak, as I've showed you in class. The S&P 500 held its own for quite a long time and did not begin its decline until sometime later, kind of triggered off by the failure of a company called Enron. That's a separate story in and of itself. There were huge .com casualties. The tulip bulb scandal that I'm referring to here at the bottom of the slide was an ancient example of overspeculation where the market came crashing down many centuries ago. And so this sort of phenomenon where prices are bid up insanely to high levels and then there's a collapse has repeated itself in many markets including the stock market multiple times, but also, as I suggest here, in tulip bulbs, in securities for South American railroads, for example, there's an example, and of course in cryptocurrencies, there's been at least one significant collapse from the peak of Bitcoin not so long ago. This again is a graph of the NASDAQ itself. That's the tech-heavy index. And you can see that the peak was 5,048.62 on March 10th, 2000, and was not again approached until many, many years later. Both the S&P 500 and the Dow returned to their 2000 highs. And this is monthly data from January 81 until September 14. So now, of course, the NASDAQ has gone above that peak, but it took a very long time for it to return. I want to talk about a special feature of this that actually matters a great deal, even in this class, and that is what I call event-based pricing reactions. You may remember that I gave a lot of attention to this discussion of rational expectations and the role it plays when small bits of news come onto the market and have a major disturbance. And I attribute that to people using whatever snippets of information they can get to recalibrate their guesses about how companies and the markets in general are doing. And we had some discussion of that in the class. Well, this is tied to that. As I write here, aside from underlying fundamentals, like expected earnings and dividend rates, stock prices will reflect conditions imposed by economics and political events, such as Federal Reserve policy, the situation in the Middle East, oil prices, elections, and are sometimes very sensitive to news events. Sometimes those news events, if directly about the companies in question or the markets, will obviously affect it, but sometimes news events that seem unconnected will also affect the market greatly. If stock prices respond to expected earnings estimates, then obviously they will change with a single news event if it seems to have any tie to earnings. Also at work sometimes are market-specific forces like momentum and what I call Ricardian events, which I'm going to explain later in this lecture. A Ricardian event is an overreaction to stressful news, when the markets simply sell off far too much beyond any reason just because they've heard what appears to be bad news. Momentum we've already explained. And so these slides show how the market was hugely impacted by an event. Well, this slide says 10 years ago. It was now more than 10 years ago. It was 20 years ago. This is an old slide. The September 11th, 2001 incident. That was actually integral to the market's decline. The market was already declining by the time this happened, but this accelerated it greatly and pushed the low to new lows. But this is an example of an event-based pricing. So prior to this disaster, you know the disaster, on September 11, 2001, terrorists fly hijacked jets into the World Trade Center and the Pentagon, killing somewhere around 4,500 people. The markets were closed immediately after until September the 17th. So the markets were closed for nearly a full week, or actually more than a full week. And European markets, though, stayed open but were down sharply, and bond markets were open and showed this enormous flight to quality, where people were apparently selling off other assets and buying safe United States Treasury bonds. That was evident during these 6 market days when the market was closed. The economy was also showing signs of accelerating decay. Just in the week before September 11th, as is seen on the next graph here, unemployment rate shot up, and the August unemployment rate soared to 4.9%. This statistic had a hard impact upon the market, and it was released the Friday before the bombings. So unemployment rate shot up, and the timing of the disaster could not have been worse because the market was already in a foul mood. What resulted was what I refer to as a Ricardian event, an overreaction to the news. I'm going to tell you a brief story that explains it. The term Ricardian event is my term. I invented it many years ago in reference to the famous classical economist David Ricardo, who wrote, I'm paraphrasing because he took many words to write this, that people overreact to distressing news. And the example often given in the Ricardian context was the reaction to the Battle of Waterloo, when there was an enormous collapse in British bond prices because of the fear that the French would win that battle. Ricardo realized that the reaction was excessive, and he borrowed a lot of money to buy collapsed security prices. As it turns out, of course, the British won the Battle of Waterloo. The prices recovered, and Ricardo made a lot of money. But in his commentary about such events, others and Ricardo have remarked that people sometimes simply overreact to bad news. And this was clearly, I think, an example of that. As this slide shows, again, the ground was already laid because the unemployment rate was up to almost 5%. So the Ricardian event is shown here. The market was at this time at 9,200, and this is the Dow Jones Industrial Average we're looking at, because now it's spreading beyond the NASDAQ and going to the S&P 500 and the Dow. And on this one day, on the day after the market opened, the Dow lost 14.3% of its value in 1 week and was the greatest 1 week loss since the Great Depression. The S&P lost 11.6, and the NASDAQ comp lost 16.1, and losses in Europe and Asia were even greater. And I remember that event. The stock market just seemed to be plunging. Now, that would be like the Dow Jones Industrial Average these days falling 2,000 and 3,000 points per day. That's how much the market in relative terms was coming down back then. And the total market volume on September the 17th was, for the time, a staggering $2.3 billion. Now, the interesting story is what happened to the individual companies that were caught up in the dot-com crash. Because although when we take a look these days at, for example, the mortgage crisis, and we saw stocks come down a lot, that would be like Intel falling from 40 to 25 or from 30 to 10, stock like Cisco cutting their value in half. A very large number of the market darlings in the year 2000 went to zero and disappeared off the markets. So if you were an investor in that company, you couldn't sell out and get 50% of your money back. It went to zero and disappeared, and you never got a penny back. And what I'm going to provide here are some examples of those. The original, of course, was one I already talked about. I talked about this in the discussion about the IPOs. The 1998 darling, this is kind of early in this period, and that was the Globe. And the Globe shot up to prices higher than this because these are split adjusted prices, and there was a split of 2 to 1, so this graph would means that the original price shot up to more than 70. And as you can see, the Globe peaked at what on this graph is 36, but before the split it would have been 72. And then it came down and it finally trickled off and finally went to zero. And the stock IPO'd in November 1998 and rose 600% on its first day of trade to $87. And then again, it later split, came down a little bit. The company was founded in a Cornell dorm room in 1994 by these two gentlemen who are named here, and they were fired from the company in August 2000 because apparently they didn't actually know how to run a corporation. And the stock was delisted in late 2000, and on August the 6th, 2001, the stock was trading for 6 cents per share. And so this was kind of characteristic of the internet darlings of those years. Now, there were classifications of companies about which I have a much larger list, but I'm only going to talk about two to give you some examples. One of the hot categories of stocks in the 1990s, and there were mud startups, by the way, working in these businesses, and I was active as an advisor to some, and some of them were B2C and B2B businesses. A B2C business, and this was some of the jargon of the period, was a business to consumer network startup, which was supposed to sell goods to consumers. There weren't many mud stores, mud companies in that. Some of them survived, like Amazon was the first of the largest to survive. eBay was another. Amazon, you may recall, if you know anything about the history of the company, started by selling books online to consumers. And so they began to replace the traditional bookstore, and then, of course, their growth into other areas is famous. But there were others like eToys, which was based in Santa Monica, Webvan, which delivered groceries to your home, which is now once again an Amazon business, whether profitable or not. They tried to do it, and DotCom had problems, and so all but Amazon disappeared from this business. They had huge customer acquisition costs that they couldn't pay. eToys, for example, had that problem. The cost they had to pay in marketing to get a customer was astronomical back then. They also had very high branding costs. The cost of getting the name known through advertising was very high. The real problem they had, though, especially eToys, which could have been as big as Amazon, because again, they specialized in toys, but had they succeeded, they could have branched out to other areas, just like Amazon did with books. Returns of unwanted merchandise was a big problem. It really cuts into your profits when, of course, your costs rise for returns of unwanted merchandise. Amazon still has that problem today. Payment inconveniences, the way you paid on the internet wasn't as well established then as it is now. Poor customer support for some of these companies. And what killed eToys was delayed orders, because they were famous in either 97 or 98, I think 98, for not getting their Christmas toy orders delivered to people by Christmas, and that alone tanked that company. So when we look at their fate, looking at Webvan, which, as I say, was a company designed to deliver groceries door to door, they started out optimistically, and their stock went to zero. Another type of company that had, or a category of companies that had problems, were the B2B companies. Before, the example was B2C, business to consumer. These are the companies that MUD companies tended to be involved with, like Infostry and Horizon, two companies that had a chance but failed back in these days, although they never were publicly traded. They failed before they got to that point. B2B means they're servicing businesses. And the example I love to give was the spectacular rise and fall of Ventro. They had very expensive development costs, so it really went through a lot of cash flow. They had huge marketing costs trying to approach these enormous businesses that they wanted to service. They had, their pricing was yielding very negative gross margins, and so if you know anything about this, you're saying, well, that sounds like Uber and Lyft today, although those are B2C. Yeah, the problems have returned in the sense that when you look at these newer companies like Uber and Lyft and even WeWorks, and we'll see whatever happens to them, they also have negative gross margins because they spend they spend more money than they make on revenues by quite a bit, and that's a money-losing proposition, so they have to get their funding from somewhere. Software back in those days didn't work as well because it was all brand new. The only reliable database that existed at that time was the original version of Oracle. And I knew mudders who programmed in Oracle, and it was very, very difficult to program in Oracle databases back in those years. And so the software, and especially database side software, didn't work all that well. There was resistance from these larger companies to actually use this software. And I remember somebody saying or writing, DuPont doesn't need a Chemdex, which was a B2B facilitator that went broke, to find Dow. And so Ventro went from $30 at their IPO within just a few months, as you can see here, to $210, and they didn't split. So this is a great example of a stock that you see the entire price history without a split confounding the picture. You can see also there at the bottom we've got a July IPO, and we see by December of 1999 they're above $200 a share. We can see by July of next year they're down to $25 a share, and then finally they're down to zero within a year of that. And again, this was another case of where they had a very flamboyant CEO, I forget his name now, who immediately bought a business jet and flew it out of San Jose Airport and was unceremoniously fired, and his business jet was repossessed. Now, one of the problems that affected the industry we were in was they were trying to grow through acquisitions, And so they had overpriced acquisitions. There's a company called Critical Path that was a spectacular failure that I remember well, because there was a mud-connected company after the crash that was built to compete with that market, and that's Mail to World. And I was a managing director for a long time of Mail to World. So, as I say here, using the original language, these cash-rich startups with these CEOs decided to expand with acquisitions. That was the only way they felt they could expand. Again, does this sound familiar to you today? Because this has been the way of companies like Uber and Lyft and others. They pay a ridiculous amount of money for a company that offers two to the market. And you say, I don't understand what you mean by they offer two to the market. Well, hold on for just a second. Let's just say they do. You go to a meeting with them somewhere in San Francisco or even New York or downtown Los Angeles, and I think we need this little piece for our company. Now, Critical Path was a bulk mail web email server, I should say, like what Gmail is today. Critical Path anticipated that, and our company, Mail to World, served many companies outside of the United States in unbranded bulk email, and still does. And so you need little features to make your email work. Back in those days, you needed to have the capacity to add attachments to the email. That wasn't originally a feature that email had. You had to have arrangements for saving email, for basically creating email databases. And some of these companies decided to acquire the technology of that by acquiring companies rather than developing it in-house. So when I say that they spent money for a company, they say, okay, this money will provide the two to the market. So then they would pay an absurd amount of money for a company that offers fro to the market, and then they can be positioned to offer a full solution platform for those who want to go to and fro. And that sort of whimsical sense is really how the logic of these companies worked. It was perceived by investors that these companies had to offer 4, 5, or 6 different levels of functionality, and that's what I'm referring to as to and fro. So they felt the best way to do that was to spend a few $100 million on various companies that in fact would offer these elements. And they just burned through so much cash it was unimaginable. But they were never able to control their costs, and they were never able to get their prices under control. And so Critical Path was one of these companies that went to 90, stayed at 90 for a while, and they lasted a little longer than some, but eventually we picked up their market in part because they fell to 0. I became very familiar with the business mistakes they made because I studied them, I studied their company, and I studied why they failed, determined that our company, Mail to World, would not repeat those mistakes, and we didn't. We got our costs down to a tiny fraction per mailbox of what Critical Path was having to pay, especially implicitly for what they acquired. They bought Amplitude for $214 million, including $45 million cash, and they got email calendaring mostly for that. They bought Remark for $267 million in no cash, and they got internet collaboration services for that. FaxNet, they paid $187 million, $20 million in cash, and they got internet fax technology, and they bought 7 other companies for a total of $1.79 billion and $130 million in cash. And they basically spent it all, and the company went broke. We interviewed one of the Critical Path directors of business development when we were building Mail to World, and it was an interesting interview. He made it clear that when he went to Critical Path, he had no business background of any kind whatsoever, and yet he was their director of business development, and he apparently had been selling hot tubs before somebody convinced him to go to work in this senior executive function for Critical Path. Well, I simply want to give you a sense of how this market involved these technology companies that would IPO, would shoot up to $35, $40, $50 a share, or $200 a share, or $300 a share, would spend in many cases a fortune for acquisitions, were never able to put a legitimate profit model together, and then finally with the disenchantment, every single one of them, and we're talking about hundreds of companies, plunge not 50% in value. That's happened to the big companies like Intel and Cisco. They plunged to zero. So that's conspicuously different. Now, one of the reasons that I emphasize this lecture is because I see evidence of the craziness returning in some of the nuttier IPOs in 2018 and 2019, in particular Lyft and Uber, who, as I've said, seem to expand their growth possibilities past the maximum before they ever IPO'd. I think that's just crazy. And then, of course, we're working through the example of WeWork, which has been renamed to We. And that's an even more hopeless case, but that has yet to be resolved. They haven't IPO'd, and I read this morning that they're not going to IPO until the year 2020, but we'll see if they ever IPO. So anyway, I hope from these generalizations you can have a memory to some extent of the 2000 crash, because again, we're likely to see it again, and maybe we'll see it not long from now. More likely, though, it'll be further on down the time. Okay, that's it for this.